So I do think there could be some market movements on when futures open on Sunday. So my suggestion is, if you're leveraged, just be careful that your leverage doesn't get wiped out by the shock. But does this have any implications?
So as much as I warned that this US downgrade is a nothing burger, I also warned that there's going to be some implications, and that the markets could actually flush you, specifically if you're taking leverage trades. And I warned you on Discord if you're in the front runners group, but I also warned people on Twitter, and I said, just watch out for the US market open in about 3.5 hours, because even though we were testing all-time highs on Bitcoin, we were testing not all-time highs, but the highest weekly close ever on Bitcoin, I did worry that we would get flushed out, and that's exactly what happened. We had the US 10-year treasury yield spike, and then we had 157,000 traders liquidated. Now the big problem is that the spike in the 10-year yields, or the spike in yields, has actually caused a global market, a global debt crisis, because now what's happening is the rates on all global debt have basically spiked, and now it's starting to cascade across all the countries. But despite what's going on, and despite the fact that both crypto and stocks are now responding to this and are actually down, I'm actually still bullish. And I'm going to show you exactly why I'm still bullish amongst all this market mayhem, and why this actually might be a buying opportunity. Now, I've been a little bit more conservative, and I've said don't buy. But I actually think that now is actually probably a good time to start buying. And I'm going to show you exactly why, and I'm going to actually show you exactly what I'm buying. So if that sounds good to you, you know what to do. Subscribe to the channel if you're not already subscribed, and then obliterate the like button, and let's get this show on the road, guys. Welcome back. I did warn last night that this was going to happen, and it actually, it worked out or played out exactly as I anticipated. Basically, what happened was the US markets opened, or the US futures opened, and when the US futures opened, the first thing that happened was the 10-year treasury yield futures actually spiked. You can see that over here, and that had big market implications. What you saw is you saw Bitcoin coming down from its highest weekly close ever. On the bright side, we did have Bitcoin's highest weekly close ever. We closed the weekly candle at 10, was that 106? No, we can't say that. Can we say we closed it? Yeah, we closed at 106,500, which was Bitcoin's highest weekly close ever. Before that, the highest weekly close was at 104,417. So we did get the highest weekly close, but then we actually got that flush out. Now we're trading at 102,680, and the reason is exactly what I warned the reason would be. It's that the bond yields spiked because of the downgrade. Moody's did us a bit of a dirty. What they did was they downgraded US debt, but they didn't downgrade US debt in hours where the markets were open. They literally downgraded US debt after the market closed on Friday. And so the only time that markets could respond was on Sunday. And then the market responded, but the way they responded was with very, 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 very low liquidity. And now we're dealing with the implications of that. We're in a situation where, because the US is downgraded, the yields on the debt are higher. The yields on the debt are higher. That means the market is now forecasting that the Fed won't actually be able to reduce interest rates. As you can see over here, the Fed's not going to reduce interest rates. And now this is what the markets are actually dealing with. And that's really what we're going to discuss today. So if that sounds good to you guys, let's obliterate the like button. Jeez, it's actually very hot in here. Let's get this jacket off. I know it's quite a porno jacket. Look at that. Just look at that. Look at the print on the inside of that jacket. Yeah, so let's talk about what's actually going on. Obliterate the like button. Let's get going. I did actually break this all down last night on the other channel, on Crypto Live. And if you're not already subscribed to Crypto Live, I would go and subscribe to Crypto Live, because for the next couple of days, I'm actually going to be doing shows on Crypto Live. It's called Crypto Live by Crypto Banter. Just go and have a look at it. If you didn't watch that show last night, this is probably a good show to watch. This is probably a good show to watch, because it really breaks down why I think this is a nothing burger, but why I do think there are going to be some short-term implications and how you can trade the short-term implications. I'm going to help you guys with that today. So anyway, let's get into it. So as I mentioned, yesterday we watched the US market open. As the US market opened, it's the first time that any market could react. So we got the 10-year treasury yield, or all treasury yields, the 10-year up. Look at the 30-year. The 30-year is now above 5%. I just want to show you how bad how far back we're going if we're talking about a 30-year above 5%. So if we take it onto the weekly, and we go back, you have to go back to 2007 for the last time that the interest rate in the United States, or the 30-year T-bill rate, was 5%. You're going back all the way to 2007. And so that liquidated a whole lot of traders. In fact, to be more scientific, it liquidated 157,000 traders and almost $1 billion worth of trades. The majority of the trades that got liquidated, actually, I think, were ETH, which is kind of weird. So ETH, which means that the majority of the trade right now is actually not in Bitcoin. The majority of the speculation and the majorities of the futures trades is actually now in ETH, which does show that the market is leaning more towards altcoins in this part of the cycle than it is leaning towards Bitcoin, which is something that I want to talk about a little bit later as to why I'm still quite bullish on this. Also, as I mentioned, I did actually call on front runners on Saturday. I left you guys a voice note and just said to you guys, just be careful if you're leveraged. I really hope that none of you guys were actually in the 157,000 traders that were actually liquidated. As I mentioned, I think a lot of this was actually written about in Good Morning Crypto, which is our newsletter. There's a link below. It's a free link. Also, it was also mentioned on the show that we did in Crypto Live. But the reality was that this was quite an obvious trade. And the reason why this was quite an obvious trade is because in a downgrade, there's zero upside. There's no like other side of the trade where you think to yourself, what could the converse of this be? Literally, the US debt got downgraded, right? And being downgraded, there's no way that a downgrade could lead to incremental buyers, only to incremental sellers. And what I mean by that is, I said yesterday, this is quite a nothing burger. And the reason why I think it's quite a nothing burger is because it's not the first time that the US has been downgraded away from prime investment grade, right? And for those of you who missed the show last night, just very, very, very quickly. So there are three rating agencies, or there's many rating agencies in the world, but there are three rating agencies that actually count in the world: S&P, Moody's, and Fitch. And what these rating agencies do is countries and companies pay them to rate their debt. And the reason why you need to get a debt rating is because before any fund can allocate capital to your debt, they need to know what your rating is, and different funds have different rules. So like you could have a fund that says, look, this fund can only invest in prime grade debt, only AAA debt. There are some funds that say, we can only invest in highly speculative debt, which means that anything above B+, they cannot invest in. So every fund has a set of rules. Now, the way these funds work, because there are three rating agencies, generally, what funds do specifically when it comes to countries is they say, we take the consensus of 2 out of 3. So in other words, if 2 out of 3 say that something is in prime or out of prime or in high grade versus prime, then we say that is what actually counts. Now, in this case, this wasn't the first time that the US had actually been downgraded, right? It was downgraded by S&P in 2007, I think it was. And then in 2023, it was downgraded by Fitch. And so Moody's was really just the last domino to fall, right? But the trade was obvious because when that domino falls, it's not like there can be any incremental buys. They go, oh my God, the US is downgraded, let's go and buy the debt. In fact, it's the other way around. It's only that there's some funds that basically said, look, you need a 3 out of 3 agreement. Now we've got a 3 out of 3 agreement that these guys are actually dropped. And so now they're actually dropped, and now we've got to get them off our books. And so that would mean that there is some selling. That would mean that there's some selling of US treasuries. Now, when you sell treasuries or when you sell bonds into the market, what that does is it increases the rate that's offered to new buyers to buy those bonds, to make those bonds more attractive. And that's really what we're seeing now on the US 10-year treasury yield, right? Or on any of the yields. What the market is telling you is it's saying, look, the ratings agencies have looked at the USA. They have looked at the debt to specifically what they're looking for is they're looking at this measure over here, which is debt to GDP ratio. And they're saying that the United States ranks quite high up. So let's quickly go to the United States over here. You can see it over here. United States has a debt to GDP ratio of 124%, which means that it has 124% debt relative to the gross domestic product, or all the trade that the US is going to let's see if we can actually rank by that. Now, that puts the US in the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10th position, and it puts it in company like Cuba, Bahrain, Italy, Greece, Venezuela. Not really good company to be in terms of debt to GDP ratio, right? You don't really want to be in the top 10 for this method. There's a lot of things that you want to be in the top 10 for, but this is not one of those things that you want to be in the top 10 for. And what the US is saying, what they're saying about the US is, look, you're taking on too much debt. You're literally taking on too much debt. You probably have no ability to pay back this debt. And therefore, anyone who's buying your bonds needs to know that. They need to know that actually you're not a prime rated country anymore. You're actually rated below prime, and chances are there's less chance that you will repay your debt. Now, when that happens, naturally your debt has to become cheaper, or your debt for you has to become more expensive, right? So I'll give you a very simple example. If I've got a higher credit score than you, and I go and try and borrow money, right? Because I have a higher credit score, I will get a lower rate, right? And it's the same thing that's happening here. Because the US had a high credit score, you can look at this as a credit score, as a credit rating. This is the equivalent to having like an 800 or a 900 or 1,000 or whatever your credit score actually is. So because the US has had a AAA rating, they got a certain interest rate. But now, because their rating has dropped, naturally what happens is they get charged a higher interest rate. And so what the market does is we sell the debt, and as a result of the fact that we're selling the debt, the treasury yields go up. Now, the problem with the treasury, with the yields actually going up is, remember, Powell or Trump wants Powell to reduce interest rates. The Fed can't really disconnect very much from the market. They can't really disconnect very much from the market, which means that if the market's offering a very high rate, it's very, very, very unlikely that the Fed will actually start to reduce rates. And that's exactly what's going on at the moment. The market's saying, look, if the rates in the market are so high, we don't believe that Powell can actually reduce rates. So now you're in a position where the rates are increasing because the debt has been downgraded. Less people want US debt. They believe that the US is less likely to pay back the debt. And so basically the bond rates are actually going up. You can see the 10-year rates is at 4.52, and that's a big number. And then you've got the 30-year, which is it was at 5%. It's actually starting to come down here. Interestingly enough, remember that all debt is actually linked to sovereign debt, and that now you can see that the chart of mortgages is at 7.4%, which is actually the highest in this century. So the highest since in this century. The highest, if you want to take a 30-year mortgage rate on your house, it's currently now, you'd be paying 7.4% interest rate. So what does this do? Well, what it does is it means that very few people are likely to sell their houses because the number of mortgage, right? So like the mortgage rate that they're going to need to pay is very, 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 very high. And that puts the US housing market basically at a complete standstill. Also, more people are likely to default on their cars, which means that there's going to be more defaults. It's going to slow down new cars, and it really is going to slow down the economy. As I mentioned, though, I do believe that it's actually a nothing burger. And the reason why I believe it's actually a nothing burger is because, as I said, in the past, the US had already been downgraded. There's nothing new about this US downgrade. It's a downgrade. The Fitch did it before. Previously to that, which one did it first? S&P did it first. Fitch did it second. Moody's is just the third one. Also, the truth is that even though the US doesn't have its AAA rating anymore, there's very few countries that do have a AAA rating. And those countries are much smaller than the US. So you've got Australia, Canada, Denmark, Germany, Liechtenstein, Luxembourg, Netherlands, Switzerland, Norway, Sweden, and Singapore that still have a AAA rating, and the rest are basically below the AAA rating. Now, if you're a China or you're a Japan and you're holding sovereign debt, I don't think you can justify to your board that you're holding, instead of holding US debt, you're holding Norway debt or you're holding Luxembourg debt. I mean, it's like, how much of that debt can you actually hold? And so really what this does is it says you really have no choice but to carry on investing in the United States, but you're going to be getting a better deal if you invest in the United States, because you were buying these things and getting a 4.4%, and now you're getting a 4.5%. So you're getting a better interest rate for investing in the United States. The problem with what that's done is, because people are getting higher rates in the US, they now looking at the German markets and the French markets and the UK markets and the Spain market and say, look, guys, the US is paying 4.5%. So we're going to put our money in US debt. And if you want us to keep our money in your debt, then you need to make it more attractive for us. And so all of a sudden, what you're getting is you're getting a situation where debt all around the world, the rates for treasuries are basically increasing, right? So this is sparked off because it's the US, and the US is seen like the mother of all debt creators, so to speak. You're now in a situation where all the other countries have also got a debt problem, right? And also what this has done at the same time is it's highlighted that most countries probably can't pay their debt. And when you're putting money into the treasuries, and you know that most countries can't pay their debt, it actually makes it pretty scary, right? So I want to read you something that was sent to me literally as I started the show. I'm not going to mention any names because I don't think he's allowed to send me stuff. He says, I've given it some thoughts. Bonds in the last 25 years would do the opposite of stocks. Stocks would sell and bonds would get the bid. Because when you take your money out of risk, you put it into a safe haven. That's pretty much what used to happen. Stocks go up, bonds would get sold. And 60-40 was a portfolio. But now stocks go down and bonds go down. It's been like that. It's been like this also prior to the 90s. Are we in the same inflationary period? I don't think so. But maybe a high debt to GDP ratio is making owning bonds unattractive to bondholders. Currently, a 125 to 130% debt to GDP ratio gets you thinking. At this rate, will they be able to pay the interest? Will the US and will all these countries actually be able to pay the interest? Or they will just have to keep raising debt to pay the interest. That's like you maxing out your credit card and then using another credit card to pay your credit card. The banks would just never let you do it. The other alternative is to stop spending, which is also off the table now. So as a bondholder, why would you buy or hold US government debt? It doesn't seem attractive since they will keep printing and devaluing the currency. And that may be why we see bonds get a bid when stocks get a bid and bonds get sold when stocks get sold. And so now we're in a situation where you're getting bonds getting sold. And now also you may be getting stocks also getting sold. As I mentioned to you, it sparked this like global debt contagion where all rates are basically going up. The Japanese bond yield, remember, Japanese is traditionally interest-free. That created what is called as the Japanese cash and carry trade. Japanese cash and carry trade was where you borrowed for free in Japan, and then you took that money because you were borrowing it for free, and you invested it in the US and you arbitraged the whole thing. Now we have a problem. The problem is that the Japanese rates are exploding. They're the highest that's been in the last 2 decades. And actually today, you can look at that's the Japanese 40-year treasury yield. Just look at that. Actually, this chart, which only goes back to 2008, has never, ever been higher. And now you've got the Japanese prime minister saying that their situation is actually worse than Greece. And you'll remember that Greece wasn't in a very bad situation and actually defaulted on their debt. He said, look, the reason is the Japan debt to GDP ratio is over 260%. Again, why? Because what they're doing is they're doing the Japan cash and carry trade where people borrow money to invest in other countries. They've got an aging population, so they're not actually producing, and they've got very, very, very high healthcare costs. They've got a shrinking birth rate, means that fewer workers and less tax revenue. And they've had decades of stimulus, and now that stimulus has basically stopped. So the Japanese outlook is not very good. And he says, look, we're actually looking a lot worse than Greece. So let's talk about the actual solves here. Like how can this be solved? How do they actually solve this? So long story short, there's no one to buy the debt. Just think about it like that. Like there's no one to buy the debt. No one wants to buy the debt. But you've got to get the rates down. So what do? Well, you buy the debt yourself. It's very simple. So if there's no one to buy your debt, then that's pushing down bond, and that's pushing down the yields. I've got a great idea for you. Just go into the market and buy all your debt. And by buying all your debt, what you'll get is you'll get less sellers, and you'll get a lot of people actually going into the thing. Let me just close Discord here because it is beeping every time that the message comes out. Let's just close that. So what do? You go into the market and you end up buying your own debt. Where do you get the money to buy your own debt from? It's very simple. Switch on the printer. Ask if Jerome Powell ain't going to do it, then let the Treasury actually go and buy their own debt. Now, by buying your own debt, you're putting a lot more money into circulation, but you are reducing interest rates. Long term, you are just exacerbating the problem, because all you're doing is you're just increasing more debt. You're taking out more debt, which means your debt to GDP ratio will get much worse, which makes your solvency issues much worse. But it is a potential solution. It is a potential solve. If you want to solve the issue in the short term, as Arthur Hay says, he says, quite a move. The BBC's a notice. If this bleeds into higher volatility in the move index, expect immediate policy action. And he's basically saying, look, there will be policy action to try and actually fix this, right? Again, it's a big problem because it takes your debt to GDP ratio, and it's going to make your debt to GDP ratio much worse in the long term. So what are the other ways that you can actually do it? So the Federal Reserve can actually cut rates, but they won't cut rates, because if they do cut rates, they're worried about inflation, right? They could also they could also do quantitative easing, which means that instead of tightening and buying, they can actually start quantitative easing. What they can also do is they can actually go into a policy, a fiscal policy, which is guaranteed to reduce deficits. Now, the problem is that if you do that, the ratings agency actually monitor you on that plan. And the problem is, as soon as you deviate off their plan, they basically come for your neck, right? And that's exactly the problem with one of those plans. And that's why, for now, I don't think that the US is actually going to go onto one of those plans, because if they do, then they're going to be monitored on that plan, and for sure they're going to deviate. On that plan. So what is the silver lining here? Why am I still bullish? How come even despite the fact that bond yields are melting all around the world, I'm still bullish? The first thing is that I actually believe that there is a chance that the Fed will actually, or the Treasury or the US will actually end up buying its own debt. Believe it or not, I actually think that is a real option at the moment, and that it may actually happen. Also, remember, if no one wants your debt, right? Imagine like a world where no one wants your debt. If no one wants your debt, no one wants your currency. And if no one wants your currency, then actually what's going to end up happening is that your currency is going to devalue. And if the currency devalues against all other currencies, then what's going to happen is all risk assets, which are denominated in your currency, are actually going to go up. Okay? And now, basically, what's going to end up happening is we're hoping that the 𝗥𝗢𝗃 is going to break down. So you may ask yourself, well, why hasn't the 𝗥𝗢𝗃 broken down already? It's very simple. Because right now, it's not only US debt that is actually melting, or that is actually falling apart. It's everybody's debt, which means all currencies are starting to weaken, and they're weakening by this. There's less demand for everybody's debt, and therefore there's less demand for everybody's currency. And so all the boats are going down together. It's like altcoins move together, up or down. But eventually, what I think is going to happen is I think the 𝗥𝗢𝗃 is actually going to break down exactly like it happened in Trump's first term. So if you go back to 2020, Trump came into power in 2016-17. Right, and there it is. You can see it actually broke down, and the 𝗥𝗢𝗃 actually went down to 88. If a 𝗥𝗢𝗃 did break down to 88, that would be amazing for Bitcoin and altcoin. So one is, I do believe that they may actually flood the system with money, because that is one of the short-term fixes. And they do have other fixes. It doesn't have to be the Treasury. They can just change a couple of rules in terms of the bank's lending ratios, and then the banks will start lending more, and then there's going to be more money in circulation. The other thing is, I mean, we're just about to have a golden cross on Bitcoin. We are 2 days away from a golden cross. I mean, the golden cross traditionally has actually been a very powerful move for Bitcoin. So if you look at previous, let me see, I think I had a previous, okay, I don't have the exact ones, but if you look previously at every time we've had a golden cross on Bitcoin, there's your golden cross there. I mean, let's just quickly look at how much you went up from the golden cross. We went up about 65% here from the last golden cross. And if you go back, you'll see that a lot of these golden crosses actually yield really good results. The Coinbase premium came back. I see a lot of spot buyers for Bitcoin all of a sudden. And again, the reason why we might be seeing spot buying is because if Bitcoin is tracking gold, look at what happens to gold every time that, or the last time. This is when S&P downgraded, gold went up 20%. When Fitch downgraded, gold went down 8%, but then it went up 93%. So this is actually when people run out of the one safe haven, because it's not really a safe haven anymore, then they're going to go into another safe haven, and gold is the other safe haven. Also, just generally, if I look at the S&P 500, you've gone up. I'm going to just quickly break it down into days quickly. So you've from here to here. You went up, in the last month, you've gone up 23%. So if we get a slight pullback in the S&P, my thesis still remains bullish. And for as long as the thesis remains bullish, I actually think this is quite a strong thing. Yeah, so that is effectively why I still remain bullish. That is why I still remain remain bullish. Just guys, if I mean, someone said thank you, Ferran, for making this simple to understand. I really have tried to break it down very, very, very simply, because I do know that when it comes to altcoins and stuff, it's quite easy. But when it comes to macroeconomics, the concepts may be quite complicated. Yeah, so just let me know if you do understand it. If you don't, I'm very happy to help you here. Yeah, someone says also when interest rates go up, it lowers the value of already existing bonds. Let me actually show you that, because that's actually quite a very good term here. So if you go to TradingView and you say US 10-year, US 10Y, that is US 10-year Treasury yields. If you remove the Y, so you literally just take out the Y, that shows you the price. So that is the price of the US Treasury yield. So you can see that the price goes down from whatever it was, 104 to 97 or whatever. So you can see that actually, yeah. Yeah. So let's look at altcoins. I mean, if you look at the altcoin market, Josh, is this a new bubbles or something? Wow, it looks amazing, bro. Okay, wow. So you got the buttons moved for here. Oh, wow. It really looks like a very cool trading terminal. You still got your crypto and stocks. I see the newsroom's got a bit of an upgrade, shall we say. Amazing. Wow. And you can put your own watch lists in here. You can create a watch list and then you can see all the bubbles from your watch list. Very cool. Very cool. Very nice. Very, very nice. Anyway, I digress. Let's go back to the non-watch list. Let's go back to the banter bubbles. And let's look at actually what's happening in the altcoins. So a bad day on the altcoins. You can see a bad day on the altcoins, but maybe a good buying opportunity. You kind of know what the winners are in the cycle. It's the ones with good fundamentals. So, and I saw this chart over here. Just have a look at this chart over here. This is a chart that just shows annualized fees. And if you look at the annualized fees and you sort by annualized fees, it really shows you all the tokens that are really generating fees. Things like PancakeSwap, Uniswap, Jito, Hyperliquid, of course being, I mean, like an annualized fees of like $1 billion, Lido, Radium. And so I think if you're going to go into tokens right now, go into the ones that are quality. Like pretty much any of the ones on this list, not any, but 95% of the ones on this list are really where I'd be putting my bets. Yeah, so I think that's it for today. Just remember, guys, again, this is a nothing burger, and it's going to take a couple of days for the market to realize it's a nothing burger, or to digest it. It's a nothing burger, and then life's going to actually go on, right? Then life's actually going to go on. Remember also that today and for the next 24 hours, there's a buy one get one free on Bitfunded. I haven't told Bitfunded about it yet because it was just an idea that came to me now. If you don't know what Bitfunded is, if you want to trade with other people's money, this is called a prop trading firm. Essentially, you buy a challenge, so you can buy like a $5,000, a $10,000, $15,000 challenge. You pay $149. If you get over 8% on the first challenge, 5% on the second challenge, then the third time you're actually trading for free with someone else's money, and you keep 90% of the profits, and they keep 10% of the profits. So if you want to trade without blowing up your account, or if you don't have $15,000 but you only have $150, but you do want to trade a $15,000 account, this is where to do it. You want to take that out? Just go to here and use, or just go to bitfunded.com. I'll phone him and tell him to make you guys whole. All right, I'll see you guys again tomorrow. Until then, don't panic and trade well, my friends.